Alrighty, good morning and welcome to the International CPE for CPAs. We are really excited that you have joined us today. We have some really good content. A few housekeeping items that we want to share is we've asked everybody to keep your microphones muted just so we can have a streamless presentation. We will be monitoring chat for questions, so if you have any, please pop them in there and we will do our best to answer them. If there is time at the end, we will do a brief Q&A session. If not, we will reach everybody offline. This presentation is being recorded and we will be sending out the recording along with the presentation slides and an evaluation link after the meeting. And with that, I'm going to pass it over to David Cumberland.
Good morning, everyone. And again, thank you for joining us today. I mean, our hopes are just to convey some high-level information to assist you as you go into tax season. And, we have our four presenters. We'll have a polling question in between each presenter for you. None of them too onerous, thankfully. And I'll be talking about the K2, K3 reporting, disregarded entities, and maybe a few little tidbits about entity structures and considerations there as you talk to clients. Anna Maria will be talking about our favorite subject of PFIX. Caroline's going to talk about estate taxation of the non-resident aliens. And then Renee is going to talk about determining U.S. income tax status and why it matters. As you'll find in this area, it's all about identifying the scope of work early so that you don't go down the wrong paths. You can go next. And next. Yeah. So, as I'm sure you're all aware, we have the new K2, K3 reporting, and honestly, this is existing reporting, but now it's being put onto actual forms. So instead of having your plain paper statements attached to the K1s, you're now actually going to have a K2 and a K3. This is new for 2021. It affects basically your pass-through entities, your 1120S, 1065, and then your 8865, which is the form used to report ownership of foreign partnerships. The K2 at a high level is just an extension of your Schedule K. It's designed basically to replace and enhance that reporting of what were lines 14 and 16, the distributive shares of foreign transactions. And then your K3 operates as that form portion of the K1 that reports each partner's portion of the items included on Schedule K2. So those were the items that were prior to those white paper statements. You're going to see as you get looking at the reporting forms that for the 1065 and 8865, since they both deal with partnerships, they're very similar style in reporting, whereas the K2 for the 1120S is going to look a little bit different. Thankfully, there are final forms and instructions available on irs.gov currently. So, make sure you look for those because sometimes when you're searching, it'll still pop up the draft, but there are final forms out there. And for your 1120S, this is replacing line 14 for the foreign transactions, and then line 14 on the K1, where it's that shareholder's share of income deductions, credits, and foreign transactions. And it follows that same pattern throughout, where it's the K and Schedule K and K1. Now, the value of this K3, why it's important to pay attention to it is this is going to provide the information necessary for partners to figure their foreign tax credit. So for your corporation that are receiving it, it's the Form 1118. And then for individuals, it's your Form 1116. So the things that we're seeing next is that they have issued a notice already, thankfully, that is offering penalty relief for the 2021 tax year. Now, they are anticipating that e-filing for this will be available for the 1065 March 20th, the 1120S mid-June, and the 8865, unfortunately, not until next January. Of course, you're just going to have to keep an eye on updates as you go through tax season to see if any of these come earlier. But, we just don't know. There's not enough information out there right now. Next. For the penalty relief, next slide, please. What this is is it's for the 2021 tax year, and it's for incorrect or incomplete reporting. And this is that you have to have a good faith effort. So it's not that reasonable cause like you see on a lot of things. For 2021. They're allowing a good faith effort to be made to comply with this standard. And good faith, as they're defining it, is determining whether a filer, when they're filing these schedules K2 and K3, they're taking account these factors: the extent to which the filer has made changes to its systems, processes, and procedures for collecting and processing information relevant to the filing of the schedules K2 and K3, the extent to which the filer has obtained information from partners, shareholders, or controlled foreign partnerships, or applied reasonable assumptions when the information is not obtained, and also the steps taken by the filer to modify the partnership or S Corp agreement or governing instrument to facilitate the sharing of information with partners and shareholders that is relevant to determine whether and how to file schedules K2 and K3. As we well know, when you're working in some of these structures, it's difficult to obtain the information you need. Of course, the clients struggle to understand what they're supposed to even provide you. And the issues we see coming out of this are going to be, historical shortcomings, where potentially you've done, maybe some of the reporting that was required, but it wasn't as robust as maybe it should have been. So this is going to be like a quote unquote catch-up year, where you're going to have to go back to the client and maybe ask them to look back historically to get you the information you're going to need to put onto these forms. Thankfully, we do have the forms to lean on and just kind of say, hey, the IRS is requiring it in a specific format this year. That's why I'm asking for this information historically. And an area where we see, historical shortcomings might be in relation to FDII, which is that foreign derived intangible income under Code Section 250. And that applies to your C Corps. I know a lot of practitioners don't work with C Corps as often, simply because you're generally working with US people, and they lean on the transparent structures. Working with non-residents or individuals that have cross-border, we see a lot more C Corps, we see a lot more fiscal years. So remember that, for tax years beginning after December 31st, 2017, the US corporations can claim this FDII deduction that's generally determined formulaically. It provides an incentive to domestic corporations in the form of a lower tax rate on income derived from tangible and intangible products and services in foreign markets. So it's meant to be a good thing, FDII is, because they do enough bad things with the GILTI tax, the transition tax that came in with the Tax Cut and Jobs Act. And just be aware as you get into that FDII that it does exclude certain types of income from it. So you just have to, again, work your way through the formula. You may find that, to the extent that insufficient detail was provided in prior years, the partnership or S Corp can be subject to penalties. For example, in the 2020 tax year, failure to provide all the information required would trigger a penalty of $280 per each insufficient Schedule K1. And then if the information requirements is intentionally disregarded, which, I would expect with this group as practitioners that no one's intentionally disregarding this reporting, but that 280 penalty can be increased to 560, or if greater, 10% of the aggregate amount of items required to be reported. And that's the challenge in this area, is that the risk exposure is so high because the penalties can be so high. We see with just the disclosure forms, the penalties of $10,000 and $25,000, 50% of the highest bank balance for the FBARs as potential penalties. So this follows to some degree a similar trend here. We also see, going into this tax season, one of the challenges is this additional workload. I think it's fair to say probably we all have been experiencing that over the last couple of years, whether it's due to staffing shortages or just the increased level of communications we've been seeing from clients. The best we can suggest here is just, a proactive analysis of your client base, really looking at how many of these do you feel like you'll have to prepare, as part of the work you're doing this year. And then also looking at how many you're going to receive potentially. From our perspective, we have a smaller team that's dedicated to learning the preparation of these forms, actually filling out the K2, K3, and then we're doing broader firm-wide for the input of when these items are received from third parties. So, I think having your arms around how much time you anticipate needing to spend preparing and how many clients and instances on each client that represents versus how many of these do you think you're going to get. Again, you should be able to look at 2020 to get a good sense because this reporting isn't new. It's just going on to these standard forms now. We are, internally, just to share part of our process, doing dry runs. So we're taking the 2020 information and actually running it through the 2021 software to get a sense of how long we think it will take to prepare these items, and that'll let us better help prepare the bill managers for additional time they're going to need to plan for their staff to prepare these things, as well as looking at the clients and how early do they maybe need to start going back to these clients to encourage them to work on these items first to get them that historical information they're going to need. We also anticipate seeing work compression closer to the extended due dates. As you all know, when there's new forms, guidance continues to come out and things change. We anticipate, seeing in that run up to the August, September, October timeframe that we're going to see more of the K1s that have the K2s and K3s coming out that time period as opposed to maybe earlier in the year. So in the run up to our extended deadlines, we're going to see more work compression, which just means we have to work proactively with those clients that don't have this kind of reporting to encourage them to get their work in earlier in the year. So we do have the capacity to deal with these things coming in later. Now, as we look out to the future on the K2, K3 reporting, what we're seeing from the administration's fiscal year 2022 revenue proposal book, that green book, that there are proposed changes in there that could become effective for future tax years for these schedules K2, K3, and they could change drastically. Just like we've seen the schedule, the form 5471 evolve significantly over the last several years, where each year there are significant changes to it. And, it's trying to use the same as last year approach just really isn't an effective approach with that form. We have the same potential here with the K2, K3s that, there could be significant changes as the IRS starts getting these forms in. The regimes such as GILTI and the FTCs could be dramatically different from their current form if tax reform goes through, as both are proposed to move forward to more of a country by country calculation. And these recently released forms of the K2, K3 aren't designed to report at that level of detail. So again, proactive communications with the clients, making sure you're getting that country by country detail may be helpful to start training them that way now, since we're seeing it move that direction. Next slide. Now, moving on to the disregarded entity reporting. Remember that this reporting came into effect for the tax years beginning on or after January 1st, 2017, and ending on or after December 31st, 2017. Next slide. Now, remember, with the disregarded entity reporting, you need to have three things that must be true. You have to have a reportable transaction between a reporting corporation and a related party. So these are your 25% or more foreign-owned entities. And for the DE reporting, as we call it, the disregarded entity reporting, generally you're running into this with the LLCs. That's where we see it. Single member LLCs is what first comes to mind. But bear in mind, that's not the only kind of disregarded entity we have. You can have trusts and other types of entities as well. So again, it's issue identification in this area. Especially we see this because historically no one had reporting in this area, that a foreign person could purchase a piece of real estate inside of an LLC because someone advised them to do so. Whether that was good or not from a home country perspective is a different conversation. But from a US perspective, there was no reporting prior to the enaction of this date, where it says basically that, under all sections of the tax code, this entity is disregarded for tax purposes with the exception of 6038 Cap A. And under that section, it's treated as a corporation. Now, the reason this came about is basically being driven by financial transparency. It comes from the rest of the world has their standards on how they disclose ownership of entities, and the US, has become somewhat of a tax haven to a great degree because it allows that ownership to be obscured. We know on Sunbiz, someone could form an LLC, list someone as a manager, and not show any ownership at all. So this is to some extent the IRS's efforts to play nice with the rest of the world and say, yes, we're requiring the disclosure of this. And through the various mechanisms we have to share information between countries, that information becomes available to the other countries so that they can track some of this activity for their tax residents. The reporting corporations, what you're going to have is either, a 25% foreign-owned US corporation or a foreign corporation engaged in a US trade or business. Can also be drug into this. For related parties, you have to be aware that there are different attributions rules that are being applied. So, it might be direct, indirect, or even constructive ownership under Section 813, and attribution under the 267C can apply to the extent they attribute ownership to persons to whom Section 318 does not attribute ownership. So the attribution rules can get muddy here, and it is a process to work through, making sure that you've identified the various related parties in this, and recognize that for the forms 5472 that are generally attached to these foreign-owned entities, it might be a C corp or might be filing on 1120F as a foreign corp. With the disregard of the entity reporting, there is a difference in the reporting requirements, that they've kind of expanded the definition of what a related party reportable transaction is. And it includes also amounts paid or received in connection with the formation, dissolution, acquisition, and disposition of the entity. And this includes contributions and distributions to and from the entity. So, you have to really look at basically anything that's passing between related parties with this disregarded entity reporting. If you have, again, the simplest example is that foreign person that owns a piece of real estate through an LLC, the LLC doesn't have an EIN because it doesn't need one. They've gotten a bank account in their personal name and they pay things for, the piece of property through their personal bank account. And those all get drug into this reporting. Next slide. So just be aware that what we see oftentimes is people come to us that we're finding more and more as time goes on, people not in compliance with this, like they've never heard of this disregarded entity reporting. I mean, each firm has to decide how they're going to approach resolving kind of that disconnect, because we see them coming to us for handling of FIRPTA transactions. Oh, I'm selling the piece of real estate. Okay, great. We start looking at who's on title and we see that it's an LLC. We find out it's a single member LLC, which is disregarded. And then we of course have to advise them that they had a reporting requirement, and you have to work through that with them. And of course, because there's these substantial penalties of $25,000 per form per year, it's not insignificant. For anyone who operates in this area, you're well aware that it's extremely difficult with the IRS to argue reasonable cause that they do not like to remove these penalties from if they're missed. Now, thankfully, with the disregarded entity reporting, it's not what's called a systemic penalty. A systemic penalty is the penalties associated with the 5472s as it relates to when you're filing an 1120 or an 1120F. Basically, you file one of those forms with the form 5472 attached late, the systemic penalty applies, which means no human being needs to get involved with the process. The system recognizes that the form is late and spits out the penalty. With disregarded entity reporting, next slide, we'll see that it's not the same penalty application. It's not systemic in nature. It's going to need someone to actually look at the reporting, determine that it was late, and generate a notice. So as you know, there's a specific mailing address for this reporting to be done. It's not the same as your 1120 or 1120F mailing addresses, and you don't e-file it. It's either mailed or faxed to the IRS. So, there is slightly more wiggle room there that you're not going to get that systemic penalty applied. We haven't seen notices generate yet, but we're still, it's still early days, honestly, in these reportings where we're starting to see people who haven't been in compliance and now they've engaged us to go back and prepare, late filed returns. Recall that the disregarded entity reporting, it's done with that pro forma 1120, and really the 1120 is blank with the exception of the name, the address, and then the attachment of the form 5472. The 1120 acts as that vehicle to get the 5472 to the government. You do not submit these separately. They have to go with that pro forma 1120F. Next slide. I've included, some examples here of different scenarios that you can encounter in the slides. The slides will be provided after the presentation. Next slide. So that you'll kind of see what are the more common permutations of this. Next slide. Now, just to touch briefly on entity structures and non-residents, I think the important thing here when you're working with entity structures is, number one, recognizing that, we generally, at least from our firm's perspective, we only provide tax advice on US tax compliance. So one of the first things we always say is you need to run this by your home country advisor that has the requisite knowledge and understanding of cross-border activity to let you know how this structure that you're considering or you have formed in the United States will be treated back in home country. As I'm sure many of you are aware, LLCs tend to be bad choices for non-residents. As with the discussion about the disregarded entity reporting, that's one example. There can be a disconnect between treatment if it's disregarded here, but that LLC is treated as a corporation back in home country. They can have a disconnect of tax credits. They can have bad results from, distributions coming out of that LLC that from our perspective are a nothing kind of transaction. You've got that foreign person that owns a piece of real estate in an LLC. They sell it here. It's disregarded for tax purposes. They get their $500,000 in proceeds, and they take that from maybe an LLC bank account out to their personal bank account and shut everything down in the US. What does their home country potentially perceive that as? If they're treating it as a corporation, they might perceive that distribution of the proceeds as a dividend, because what else does a corporation issue out to the shareholders but dividends in many cases? So like I said, the important point there is just make sure that you're coordinating with the home country advisor as needed. And if they are looking at visa planning, we are seeing more of an uptick in visas again. It kind of got a little quiet during the pandemic beginning stages, but now we're starting to see things ramp up since travel has opened up much more starting in November of last year. So we're seeing a lot more of people that are in the planning stages now. And that involves coordination with the immigration attorney and also the home country advisor to make sure that everything works from each perspective. Also recognize that when it comes to partnerships, you've got the different types of withholding that can apply here. Under section 1446, you've got for net income or distributable, effectively connected income, that form 8804 withholding, which is done at the highest rates. Also be aware that, we had under 1446F, when it comes to the sale of partnership interest, there are now final regs out about that. And starting on January 1st of this year, January 1st of 2022, that the secondary withholding liability came into effect. So if the transferee does not withhold the amount required with respect to the transfer of an interest of a partnership, then under section 1446F4 is going to require the partnership to withhold the under withheld amount plus interest from future distributions to the transferee. So be aware that that came into effect January 1st of this year, and that this sale of partnership interest withholding is handled similar to FERPTA with similar deadlines on when it needs to be remitted. So you do need to make sure that when you have clients that are foreign persons, and foreign persons can be corporations, individuals, trusts, you name it, that they're well aware that if they have any changes, they need to let you know as soon as that happens, not wait till the following year and discover, oh yeah, I sold my interest back in April of last year, because there is potential for withholding. Again, I would leave it to you to read through the regs, and there are opportunities just like under FERPTA for exemptions and exceptions, and you just have to work your way through that decision-making process. Next slide. And with that, we've come to our polling question.
So true or false, the IRS offers penalty relief for 2021 tax year for the new K2, K3 reporting forms only if there is reasonable cause. Everybody just 1 second to answer here. All right. Thank you for that. That answer is false. All right, moving on, we have our next speaker, Anna Maria Kiss.
Everybody, and thank you for attending this morning. Next slide, please. In this part of the presentation, I will be discussing passive foreign investment companies, also known as PFICs. This presentation is not meant to be an all-inclusive training. PFICs are very complicated, so think about this as more of a highlight reel of what PFICs are, sort of an introduction. I'm also going to talk about PFICs from a standpoint of an individual taxpayer. So think about in the context of Form 1040. PFICs. In the simplest of terms, PFICs are pooled investments that are registered outside of the US. Here on this slide, I have a couple of examples of PFICs that you may encounter during your practice. These are the ones that we most commonly see. The first one is, and the most frequent, is foreign mutual funds. These funds may invest in foreign stocks, foreign bonds, money market instruments, and other assets, or a combination of these, thereby creating a mutual fund. If these are registered outside of the US, those are foreign, and they qualify for PFIC treatment. The other example I have here for you is US hedge funds. Those may also invest in PFICs, foreign mutual funds, and so on. In this case, the taxpayer usually holds an indirect interest through a partnership. Now, previously, we saw the reporting of these US hedge funds that invest in PFICs on Form K1. As David already discussed, going forward, K2s and K3s will be reporting this information when those forms become available later in the year. Other commonly seen examples include foreign insurance products, non-US pension plans, and unit trusts. Foreign bank accounts can qualify as PFICs. I say simple because that is how the taxpayer thinks about them. However, these are usually specialized savings account, for example, the ISAs or individual savings accounts in the United Kingdom, or the TFAs or tax-free savings accounts in Canada. Please note that PFICs can be held individually in the taxpayer's own name or inside a foreign trust. So in this scenario, this would mean both 1040, 3520, 3520A reporting. On the 1040, we would include Form 8621 for PFIC reporting, and with the 3520 and 3520A, we would attach to the foreign trust reporting the Form 8621. Next slide, please. Thank you. As I already mentioned, PFICs are reported on Form 8621, and accordingly, the IRS provides us with instructions, and they give us the following definition for PFICs. A foreign corporation is a PFIC if it meets either the income test or the asset test. The income test means that 75% or more of the foreign corporation's gross income for the tax year is passive income. For example, portfolio income or foreign personal holding company income. The second test, and keep in mind, to have the PFIC treatment, to qualify for the PFIC treatment, the taxpayer has to pass either one. So our goal, obviously, because it's a very stringent reporting regime, we are hoping that the client will not pass either one of these, and we don't have to deal with the onerous PFIC reporting. But so the two tests, you have to look at the income test we just discussed and the asset test. And the asset test is a little bit more complicated, and it states that at least 50% of the average percentage of the assets held by the foreign corporation during the tax year are passive assets or that are held for the production of passive income. Some examples I can mention here. The main asset of the foreign company is just simply a brokerage account that holds various investments. When you look at the financial statements, this is maybe the only asset or the main asset that you find there. The definition of passive income is determined by reference to foreign personal holding company income. What do I mean by that? What is passive income? We all know this. It generally includes items such as interest, dividends, royalties, passive rental, annuities, net foreign currency gains, any net gains from the sale of exchange or property that generates passive income. For example, sale of stocks, securities, derivatives, so on. Next slide, please. So, who must file? I believe we may have gone too far, perhaps. Maybe we are missing a slide. That is also possible explanation. I'm looking at the slide that should say who must file, but I don't see it in our presentation. So I'm just going to say this from the top of my head, not the top of my head, it's the US person who is a direct or indirect shareholder of a PFIC must file Form 8621 under the following circumstances. If received distributions from a PFIC during the tax year, if recognized gain or loss on disposition of a PFIC, when reporting information with respect to what we call the qualified electing funds, or QEFs, or making a Section 1296 mark-to-market election. There will be further explanations on both of these. Additionally, a taxpayer must file when making an election on Part 2 of Form 8621. There are a number of elections here, such as treat the PFIC as a qualified electing fund, to make the mark-to-market election, and various other elections regarding deemed sales and deemed distributions. Finally, a taxpayer may have to file Form 8621 pursuant to Section 1298F, which just means that the first US person in the chain of ownership has to file an annual report. Next slide, please. There are 3 types of PFICs. When I say 3 types, I'm talking about the same exact information, the same exact foreign mutual funds or hedge fund or savings account that we receive from the client. However, the IRS gives us 3 different variations of reporting, 3 different options, 3 different calculations, depending on the taxpayer's facts and circumstances. So the 3 types are the Section 1295 Qualified Electing Fund, or QEF for short. The second type is the Section 1296 Mark-to-Market Election, and the final one is simply called the Section 1291. Next slide, please. Section 1295, Qualified Electing Fund, or QEF. This tends to be the most beneficial of the 3 types of possible reportings. However, there is a catch. The catch is that in order to claim it, the investment management company that originally issued the PFIC, from whom the client purchased the PFIC, or the investment management company that holds their foreign account with the PFICs inside, this investment management company, has to provide something called an annual information statement, also known as AIS, or an equivalent statement to the client. So in this case, there are very specific requirements on how this annual information statement needs to look like. So most commonly, we see this with Canadian taxpayers, because Canadian brokerage houses, investment management companies are familiar with PFIC reporting, and they will provide us with annual information statements for US reporting purposes. This is why it's not very common for other countries, especially if they are not English-speaking countries. The QEF election, because it is an election, it must be made, like most elections, on a timely filed return for the first year of PFIC ownership. So this is the second catch. If the taxpayer missed this, if we missed the ownership of this during the first year, we cannot make this election in later years. So what is QEF? Conceptually, QEF is taxed like a pass-through entity. So think about the same way you think about your partnerships. Income from the partnership flows through to the taxpayer. This is also true for QEFs. Income from the fund, from the foreign fund, the PFIC, flows through under this reporting regime to the taxpayer. The PFIC income that is reported by the investment management company on the AIS returns its character on the taxpayer's return. Ordinary income remains ordinary, capital gains and losses remain capital in nature. The only difference is that the taxpayer, of course, only reports the pro rata share of the earnings of the PFICs. And I will read that again, the pro rata share of the earnings of the PFICs, not the distributions from the PFIC, because this is a pass-through concept. Whether or not income has been distributed to the taxpayer is irrelevant. What we are reporting on Forms 8621 and Form 1040 for the individual taxpayer under this regime are the actual earnings of the PFIC, whether or not distributed to the taxpayer. And income that is recognized adjusts basis going forward for future sales. Actual distributions to the taxpayer, like I already mentioned, are not recognized and not reported as income. To make the QEF election, there is a box on Form 8621 that must be checked annually. Next slide, please. The second type of the three possible reporting regimes that IRS provides us with is called the Section 1296 mark-to-market election. This is an entirely different concept from what we just discussed under QEF with the pass-through. The mark-to-market election is basically looks at fair market values of the PFICs, whether or not realized or unrealized. This is also an election, and this also has to be made on a timely filed return. The mark-to-market election can only be made by a US shareholder. This is important. The shareholder has to be a US person, and only for a marketable stock. When I say marketable, I mean that the PFIC has to be available for the general public. Anybody can buy it, and it's usually traded on a regulated exchange. So what is the mark-to-market? We are marking the value of the PFIC up to the fair market value as of December 31st of every year. And that is what we report on the tax return as income, even if it's not an actual realized income, because it's just a change in the fair market value, and it's not gain or loss from actual sale. In other words, income equals the change in fair market value as of December 31st of the current year from December 31st of the prior year. Gain or loss from this change in fair market value is recognized, and it is reported as miscellaneous income. For 1040 purposes, this would be Schedule 1, 1040 page 1, line 8. While a gain due to the fair market value change is fully reportable and taxable, that is not true for losses in change in fair market value. So this is a limitation of the mark-to-market election. While you are, not you, the taxpayer is required to recognize the gain, the actual unrecognized gain in change in fair market value. If there is a loss from prior year, that loss is limited, and the limit is the amount of previously recognized gain. If there are any dividends that the PFIC distributed to the taxpayer, those are simply reported as ordinary dividends on Schedule B. Now, let's talk about what happens when the client sells one of these mark-to-market PFICs. If there is a loss on disposition, if there is a loss on disposition and not a loss in change of fair market value, but an actual sale, that loss in excess of the previously recognized gain is reported on Schedule D as capital. So if the loss is from the change in fair market value, it is a reduction to miscellaneous income up to the amount of previously recognized miscellaneous income. But if there is excess, that gets reported on Schedule D. And this is a bit of a complicated concept to get our heads around, or at least that is my experience working with the PFIX. Just like the QEF, any recognized income adjusts basis for future sales. This is also a check the box election on Form 8621. Because we are reporting unrealized gains for the individual taxpayer, we highly recommend explaining the effects of this mark-to-market election to the client and get their approval in writing. Next slide, please. And the third and final and the most punitive, the default option is called Section 1291. When the taxpayer is not eligible for either the QEF or the mark-to-market election, maybe because there is no annual information statement or the PFIC was not reported during the first year of ownership, we have to use what is left for us, and that is the Section 1291 reporting. Now, with Section 1291, the IRS really threw the book at the taxpayer. This is the most punitive tax reporting regime that I'm aware of. Usually, about 50% of the value in the funds goes to the IRS for taxes, late taxes, late interest. So this is something we really try to avoid if possible. The IRS applies the highest tax rate to this regime, and it's not the taxpayer's highest tax rate, it is the enacted highest tax rate. So for 2021, this would be 37% for an individual taxpayer, regardless of what the taxpayer's marginal tax percentage is, or tax rate is. Income under the Section 1291 is recognized on dividends and dispositions only. So let's talk about distribution reporting. Under 1291, a part of the dividend called excess distribution, and we will talk about excess distribution a little bit more on future slides. So under the 1291 regime, a part and only a part of the distribution, the dividend called the excess distribution, is reported as ordinary dividend on Schedule B. Another part of the dividend may be reported as miscellaneous income, depending on the calculation that is prescribed to us by the IRS. And yet a third part of the dividend may not be reported at all on the current year's tax return, but it is used for calculating late taxes and late interest at the highest tax rate. Gain on actual disposition under Section 1291 is miscellaneous income. Both gain and distribution is basically allocated back through the entire holding period. So if a PFIC was purchased on January 1st, 2018 and sold December 31st, 2021, the rule for Section 1291 allocates the entire gain back to these 4 years, calculates all the days in this holding period, and calculates late taxes and late interest. This is true for both distributions and gains from actual sales. And because it's a PFIC, there is another catch. Loss on capital disposition is Schedule D. It is capital in nature. while income is ordinary income, miscellaneous, loss is capital. So loss gets a more restrictive treatment under this regime. Next slide, please. And we arrived at our first example, and this is going to be the mark-to-market election loss limitation example. Just a refresher, this is when we look at fair market value at the end of the current year and the change compared to the fair market value of at the end of last year. And that is the income that we report on Form 8621. So our fact pattern is the following. On December 31st of 2019, a taxpayer owns a foreign mutual fund. It is traded on a foreign exchange. This is important because we can only make the mark-to-market election for mutual funds, PFICs, that are available to the general public. And since it's traded on a foreign exchange, it is available to the general public. I will be making some notes to this slide, and I may be asking you to make some changes. There's been some updates, and I do not see those updates here on this slide. So please bear with me if I say something different from what you see here. So the PFIC was valued at $100,000 on December 31st, 2019, $110,000 on December 31st, 2020, and only an $80,000 on December 31st of 2021. For tax year 2020, the taxpayer reports the entire $10,000 of gain. How do I arrive at $10,000? It is the $110,000 as of the end of 2020 compared to $100,000 as of the end of 2019. So the difference between those two numbers is $10,000, and that is the recognizable and reportable gain. Even though the client did not actually realize that gain, we recognize it and we report it on the tax return, and it is reported as miscellaneous income. Let's move on to the next year. In 2021, the taxpayer has $30,000 in loss, fair market value loss. This number comes about by comparing the numbers 80,000 in fair market value as of the end of 2021 to 110,000 at the end of 2020. So the difference between those two numbers is $30,000 fair market value loss. However, as we already discussed, any loss is limited to the amount of previously recognized gain. So in 2021, the only loss the taxpayer can recognize and report on the tax return is the $10,000 that was previously recognized in the prior year. This would be a reduction to miscellaneous income on the 2021 return. Let's consider an alternative scenario. Let's say the taxpayer doesn't hold on to the PFIC, but rather sells the PFIC during 2021, and the sales price is $95,000. The difference here between the sales price and the fair market value at the end of the previous year is $15,000. This $15,000 comes about by deducting $110,000 from the $95,000 fair market value at the end of the previous year. Out of this $15,000 of actual loss, that is not just a loss in fair market value, but it is an actual realized, recognized, reportable loss, $10,000 up to the amount of the previously reported gain is a reduction to miscellaneous income. The remaining $5,000 is reported as capital loss on Schedule D. Next slide, please. And our final example is Section 1291, excess distribution example. This is the most punitive option, the Section 1291. The fact pattern is the following. On December 31st, the taxpayer owns a foreign mutual funds that was purchased for 4 years ago, let's say on January 1st of 2018. The taxpayer received distributions in all 4 years, 25,000 in 2018, 30,000 in 2019, 35,000 in 2020, and 100,000 in 2021. We are only going to look at tax year 2021 for this taxpayer and this scenario. So in 2021, out of the $100,000 distribution, the taxpayer only reports $37,500 as ordinary dividend on Schedule B. So how does this $37,500 comes about? We have to take the previous 3 years distributions, the 25,000, 30,000, 35,000, add them together, divide by 3 to calculate an average, and multiply it by 1.25. This calculation is spelled out for you on Form 8621. This is straight from the form itself. So out of the $100,000, $37,500 goes on Schedule B as ordinary dividend, not qualified. So what happens to the rest? There is another $62,500 left. This amount is allocated back over the entire holding period, all the way to January 1st of 2018. And the allocation happens on a daily basis. Out of this $62,500, there is 1,461 days in the entire holding period. And for tax year 2021, because we are working on 2021, there are 365 days in the calendar year. So what the instructions and the form itself has us do is the following calculation. Take the remaining $62,500, divide it by the 1,461 days, all the days during the 4 years, and multiply it by the number of days in tax year 2021, which is 365. And this is how we arrive at 15,614. Now, this amount is reported as miscellaneous income in 2021, even though it is actually a distribution, a dividend maybe, it does not go on Schedule B. It is recognized as miscellaneous income. Now, we already took care of $37,500 on Schedule B and $15,614 as miscellaneous income. There is still money left. So what happens to the remaining $46,885? This does not get reported on the 2021 tax return. However, it is used for calculating late taxes and late interest for the last 4 years, resulting in $7,347 as late tax and $1,268 as late interest that has to be paid with the 2021 tax return. Next slide, please. And then finally, just a little easier topic for the end. Keep in mind that foreign reporting always do a couple of different forms. It's almost never just one form. And accordingly, PFICs also have related forms. where reporting has to be done in conjunction with Form 8621. And these forms are the FBAR, Form 8938. And if the PFIC is owned through a foreign trust, then we also have to report on Form 3520 and 3520A. And with that, my presentation has come to an end, and it's back to you, Bethany.
Thank you. We are going to jump into a polling question. So what type of Zoomer are you? Are you the one walking around the house, the one who just woke up, the note taker, or the multitasker? Probably just a few seconds here. Strong command for the multitasker at the moment. So we're going to close out the poll. Thank you, everybody. And I'm going to pass the mic over to Caroline Root for our next section.
Thank you. Good morning, everybody. I'm going to be talking this morning about the U.S. estate taxation of non-resident aliens. So I'll cover some filing requirements, the required forms, and some of the current challenges that come along with the filing of these returns. A familiar disclaimer at this point, because of time constraints, this is going to be a very simplified outline of what's a highly complex subject. So please remember that with all things tax, there are exceptions and exceptions to those exceptions, all depending on the particular circumstances and treaty provisions if they apply. You can go to the next slide, please, Bethany. Okay, so the estate tax filing requirements that apply to non-citizen non-residents are very different from those that apply to U.S. citizens and resident decedents. The first thing to understand is who is a non-resident alien decedent. The term used in IRS forms and the code is non-resident, not a citizen. So the first requirement is to be a non-citizen. After that, we look at who's considered a non-resident of those non-citizens. This is according to the regs, a decedent who at the time of his death had his domicile outside the United States. So what's domicile? Also, according to the regs, a person acquires domicile in a place by living there for even a brief period of time with no definite present intention of later removing therefrom. And it does go on to say residence without the intention to remain indefinitely doesn't suffice to constitute domicile. Intention to change domicile doesn't really count unless it's accompanied by actual removal. But so the gist of this is that domicile is largely determined by intent. It's a facts and circumstances issue. And it's important to note that the determination of who is a resident for estate tax purposes is not the same as it is for income tax purposes, which I know Renee will be discussing next. But in fact, a person could be considered a resident for income tax, but not for estate tax purposes. Next slide, please. All right, so how are the requirements different for non-citizen, non-resident decedents from the way that the requirements for US citizens and resident decedents? There are differences in which assets are subject to tax, the exemption amounts, how deductions are handled, and of course the forms that are filed. For US citizens and resident decedents, I've got the 2021 exemption amount on here of 11.7. I know it's gone up above 12 million for 2022. And of course, this exemption amount is adjusted for inflation and occasionally changed, in the tax law. And the unified credit for 2021 was about 4.6 million. For a US citizen or resident decedent, worldwide assets are subject to estate tax. Full deductions are allowed on unpaid mortgages and debts, funeral expenses, and administrative expenses. But for a non-resident, non-citizen decedent, the exemption amount is $60,000 with a unified credit amount of $13,000. You'll notice there's not a specific year included there because this exemption amount, it's not adjusted for inflation. It's not been increased. I'm not sure it's ever been changed from $60,000 over the years. And for non-resident, non-citizen decedents, the property subject to U.S. estate tax is limited to U.S. situs assets. I'll go into the details of some of those assets on the next slide. Deductions are limited based on the proportion of U.S. assets to worldwide assets. So in order to claim deductions for these unpaid mortgages, funeral and administrative expenses, worldwide assets also have to be reported for the non-resident alien, and there must be substantiation of both the values of the worldwide assets and the expenses that are being claimed. Also noted in this chart at the bottom is the marital deduction. This is spread across both columns because it's not determined based on the status of the decedent. It's based on the citizenship of the surviving spouse. The marital deduction is not allowed for a non-US citizen spouse, although there's an exception if the property passes in qualified domestic trust. This is not included on the slide, but things that are not different, the way that assets are valued for estate tax purposes, valuation of the assets is fair market value on the date of death, and the same alternate valuation period is available to non-resident, non-citizen decedents by election on the estate tax return and subject to the same time requirements. Tax rates are the same, so the same tax table is used. And the due dates are the same. 9 months after the date of death, the estate tax return is due with the same extensions available. All right, next slide, please. All right, so US situs assets, this is property situated within the United States, and this is listed in the regs. I've got the regulation listed at the bottom of the slide. This is not an exhaustive list, but some of the primary things that we come across. Real property located in the United States is subject to estate tax for a non-citizen, non-resident. And this is what we see a lot of, especially here in Florida. Tangible personal property located in the US with some limitations. Stock issued by a US corporation, regardless of where stock certificates are physically located, is subject to US estate tax. Debt obligations, the primary obligor of which is a US person, so that includes US individuals, corporations, United States government, and its political subdivisions as well, so state governments also. Also subject to estate tax are transfers of any of these assets that are includable under Internal Revenue Code sections 2035 through 2038. So this is revocable transfers, transfers taking effect at death, adjustments for certain gifts made within 3 years of death, and transfers with a retained life estate. Also transfers by trust if the property held was a US situs asset when transferred to the trust. Next slide, please. So these are just some of the items listed as property that's considered to be situated outside the United States. The proceeds of life insurance on the life of the non-resident, non-citizen decedent would not be included. Bank deposits that are not effectively connected with a US trade or business and certain other debt obligations are considered to be situated outside the United States. Also works of art that are in the United States on loan for exhibition are not included. That's, I think, the primary exception to that tangible personal property, but this is also not an exhaustive list, and you can see the reg there for the full list. Next slide, please. All right, so how does this affect non-resident owners of US property? Upon the death of the non-resident owner of a US real property, a federal estate tax lien becomes attached to the property. It's a silent lien. It's not made public. And so often these co-tenants or survivors, surviving spouses, or beneficiaries of the property and executors are not aware of the need to file the estate tax return until the property comes under contract. At that point, usually the title company lets them know that they look back at the deeds and see that a death certificate's been filed, or there used to be two owners and only one is selling. And when they learn about this, they advise that they're going to need to see that the property is cleared of that estate tax lien before they can release sales proceeds. This does depend a little bit on the title company. Their policies do vary, but we have seen many cases where the full sales proceeds have been held pending the receipt of an estate tax closing document. Next slide, please. All right, so as with everything, there are, one of the exceptions would be treaty provisions. So it's important to note that the US is a partner in a number of estate tax treaties, which affect all these requirements that we've talked about: situs, domicile, credits, marital deductions, depending on the terms of the treaties. The US is currently a partner in 14 estate tax conventions, and also the income tax treaty with Canada includes some estate tax provisions. So it's important to consult all of these carefully. The provisions in each treaty are different, so although there are some similarities among some of them, it's important to read the applicable treaty carefully. A number of these treaties allow for a prorated unified credit to the estates of residents of those treaty countries. I know that's included with Canada, with Switzerland, Germany, Italy, just to name a few. And that credit is, of course, limited to the lesser of the allowable credit or the actual tax that's calculated to be due. But that does require reporting worldwide assets as well. The United Kingdom and US Estate and Gift Tax Treaty includes a provision that a UK domiciled decedent is limited to tax that would be imposed if he or she were domiciled in the US. So in order to claim those benefits, the worldwide assets of a United Kingdom decedent would need to be included on the estate tax return, just as they would for a US decedent. And also under our treaties with France and Germany, 50% of the value of property that passes to a surviving spouse isn't taxable in the United States, and there's a marital deduction allowed. So everyone is a little bit different. Next slide, please. Oh, there's one. Yeah, there we go. So the forms that are required. The estate tax return for a non-resident, non-citizen is Form 706NA. And it's a little clip of them on there. It's a 2-page form, but depending on ownership and circumstances of the decedent's assets, there may need to be additional schedules attached from Form 706. So if the decedent held property as a joint tenant with a right of survivorship, or tenant by the entirety, or with a surviving spouse as community property, Form 706 Schedule E would need to be included. And assets that are held that way, they're not reported in Part 1 as a qualified joint interest because they don't qualify. Those assets would be reported on Part 2 of Schedule E as other joint interests. If there are some of these transfers discussed previously under sections 2035 through 2038, or a trust created by the decedent that holds US situs assets, Schedule G from Form 706 would need to be included. Schedule H is included to report powers of appointment if that applies. Schedule M for the marital deduction, if that applies to the particular situation, and Schedule O for charitable deductions. Also Schedule R and or R1 if there are transfers to a skip person included. If claiming the benefits of a treaty provision, a statement is required. Form 8033 is typically included there. And the due date for this Form 706NA, as I mentioned earlier, is 9 months after the date of death with the extension of time available. Next slide, please. Thank you. Supporting documents that are required as they apply to the situation: a copy of the death certificate, a copy of the decedent's will and any relevant trust documents, a copy of each appraisal for the valuation of property, any documents that are related to litigation involving the estate, If US gift tax returns have been filed by the decedent, those need to be included. Documentation of unusual items, which would include partially included assets, losses, or transfers near the date of death. If claiming that prorated deduction for the funeral and administrative expenses or unpaid debts and mortgages, documentation of the worldwide assets and expenses being claimed need to be included. And also, if any item submitted with the return is not in English, a translation of that document needs to be included, particularly the will. Next slide, please. So Form 8971 may be required to be filed, and that depends. It's required for estates wherein a beneficiary or a co-tenant will acquire the US property. If the decedent's property is going to be held in the estate, there's not a Form 8971 necessary. So executors are required to file this form to report the final estate tax value of property being distributed from the estate. A Form 8971 and a copy of every Schedule A, each Schedule A pertains to an individual beneficiary, is used to report the values to the IRS. So these are sent to the IRS. And then one Schedule A would be provided to each beneficiary receiving property from the estate. This form is required for every required 706 NA filed after July 31st, 2015. So it's really the filing date, not the decedent's date of death, that creates that filing requirement. And the due date is 30 days, no later than 30 days after the date Form 706 NA is filed with the IRS. Next slide, please. Additional forms that are not, these are not required, but they're helpful. Relationship, we've been advised a little bit easier to get the power of attorney on file because there are some issues with the CAF unit and the power of attorney with some of these returns. So Form 56 just provides notification to the IRS that a fiduciary relationship has been established. And then the Form 2848, I'm sure everyone's familiar with, authorizes an individual to represent the estate before the IRS and to receive IRS communications. And we found it very helpful for obtaining account transcripts so that we can see the status of the return. And one reason for that brings me to our next slide, please. Current challenges. So these are some challenges that we're seeing with these returns now. And one of them I mentioned on the previous slide was authorization and obtaining account transcripts. So when these returns are filed for non-residents, if the decedent had a social security number or an ITIN, a US taxpayer ID number, this number is used on the returns. It's used on the 2848 to get authorization on file. If an ITIN is used, it must have been used previously to file a US tax return. So the estate tax return can't be the first tax form that an ITIN is used on. So if the decedent did not have a US taxpayer ID number, the IRS will assign one. It's an IRSN, which stands for Internal Revenue Service Number. This number is assigned as the return is processed, and that can take months to literally years. It's only provided to the executor because you cannot get authorization on file without the number, so the number can't be released to anyone who doesn't have authorization. There is a section on the 706 NA page 2 to authorize the preparer or other person to receive information about the return, but this doesn't apply if the return is filed without a taxpayer ID number. So that creates a bit of a challenge. So there's some follow-up involved in obtaining the IRSN, but once it's received, it's used to submit the POA. Another challenge is the closing letter. So the handling of the closing letter, this kind of depends on who's asking for what documentation that the estate tax liability has been cleared. We've found that courts seem to prefer the closing letter. The IRS states that the account transcript can be used in lieu of a closing letter, and the IRS seems to be sort of discouraging people from requesting the closing letter. For a while, it was not issued at all except by request, and as of, I believe it's October of 2021, there's now a fee to obtain the closing letter, which is $67. It can be requested by the executor or by an authorized representative. But now there is a fee for that letter. And there are transfer certificates that are issued to estates where the executor is outside the United States. And these are actually, in my opinion, more helpful documents because they list the specific property that's being cleared of the estate tax liability and state that the IRS is certifying this property can be transferred without liability under federal estate tax law. And then there's also the account transcript, which you can get if your authorization is on file. And then the final challenge, of course, this is a challenge I'm sure everybody's familiar with in basically everything involving the IRS, which is processing times and the challenges of contact. The processing times for these returns, if you read, the instructions, I believe they say 9 months, but our experience is now it's 1 to 3 years, and 1 year's would be, ideal at this point. But we've got some that were filed in 2019 that are still awaiting processing. They have to be paper filed, so of course that creates another issue for the IRS. And then contact, I'm not sure if this has been updated recently, but the last time I checked, the estate tax department was only taking phone calls between 10 a.m. and 2 p.m. on weekdays. So that does create a bit of a challenge as well. And with that, I think, Bethany, it's time for another polling question.
It is indeed. So our third and final polling question is going to be, how many hours a day do you spend on Zoom? It's like the majority at around 83% say 1 to 2 hours. Excellent. We have everybody in. Thank you so much. So on that, we are going to go to our final speaker, Renee Glendenning.
Hi, everybody. Okay, I'm the last one, so you'll be done after this one. I'm sure it's been a little daunting for everybody, and the topics we have chosen are all very different from each other. So I'm just trying to give you a smattering of the different scenarios you may encounter. Next slide, please. So my topic is how to determine U.S. tax status, and then why does it matter? So you're probably aware for a U.S. income tax status, the typical classifications are resident alien, which is what the majority of us are, or non-resident alien. And that's what generally people who don't live here are. There is a third status that you don't encounter as frequently, and it's called a dual status. And there are circumstances where an individual may be considered a resident for part of the year and a non-resident for part of the year. Those get to be a little bit more complicated, and we're not covering that, but just be aware that that status also exists. Next slide, please, Bethany. All right, so when you have a new client or even an older client, what is the status of that person for income tax purposes? How is that determined? Okay, so the first qualification is if that individual is a U.S. citizen, they are a resident for U.S. income tax purposes. Okay, now, as with everything, there are certain exceptions. There are very, very few exceptions to the U.S. citizenship rule. But for instance, if you had somebody who was a U.S. citizen by virtue of, of being living in a possession of the US. They would not be subject to the rules that I'm talking about now. But generally speaking, US citizenship, you're a US tax resident. Others who are considered US income tax residents, green card holders. If this individual has been granted a green card, which is a permanent resident visa, generally speaking, they are considered US income tax residents. Again, there are exceptions to that, but that is the general rule. Another rule that is less known is if you're not a US citizen and you don't have a green card, if that individual is physically present in the US for 183 days or more during the calendar year, generally speaking, they are considered US income tax residents. Doesn't matter where they live the other part of the year. I mean, a lot that we see in this is Canadians. Okay, so a lot of the Canadians will be spending 183 days or more during a calendar year. And just because they're Canadians doesn't mean they can't be considered a US tax resident if they overstay. Okay, another even more or lesser known is what we call the substantial presence in the US. So you're not a US citizen, you don't have a green card, you're not physically present 183 days or more in the current calendar year, but you are substantially present in the US. And that will go into what that means. But typically, that means there are circumstances where if your stay in the US over a 3-year period is 122 days or more, then you could, under certain circumstances, be considered a US income tax resident. Next slide, please. All right, so what's the opposite of that is a non-resident. An individual is a non-resident for US income tax purposes. Number one, they're not a US citizen. We do have individuals who are what we call accidental US citizens, people who maybe were born in the US, but their family moved away to another country. A lot we see is Canada. And they say, well, you know, I'm a Canadian citizen. I've spent my whole life in Canada. Well, if they were born in the US, they're a US citizen and they are subject to all the reporting requirements that other US citizens are subject to. We'll get into a little bit of how that might be rectified later. Many people have visas that are not green cards. And if the visa is not a green card, because that has a whole separate rule, then if they're not considered US income tax residents simply by virtue of having a visa that allows them to live in the US and work in the US. You still have to look at how many days were they physically present in the US, because many people with visas which allow them to stay here all year aren't physically here all year. So you always have to look back to how many days were they physically present. Okay, then you can have substantial presence in the US, okay, if you have what they call, you're a tax resident of another country, another foreign country, and you have a closer connection to that same foreign country. So that there again is another one, substantial presence, which may determine US income tax residency status. Next slide. Okay, so what is substantial presence? First, the physical presence in the current year has to be at least 31 days. So it doesn't matter how many days you were present in previous years if the current year was not at least 31 days. So if that's not 31 days, then you don't have to worry about that. we saw a lot of that with our non-resident clients who usually would have substantial presence in the US during COVID because they just couldn't get here. There were certain rules that applied for 2020, which let them exempt the days due to the fact that many people couldn't leave the US if they were here when the pandemic hit. But that was for 2020 only, and that's all done now. Other substantial presence is, as we talked about, 183 days or more, but not in the current year because that carries a different significance. But so substantial presence is you count the days that you were physically present in the US for the current reporting year. Those days count at 100%. Then you take the days in the first preceding year. So if you're looking at 2021, it would be 100% of the days in 2021. You'd look at the number of days you were present in 2020, and you would calculate 1/3 of those days. And then you would take the days you were present in 2019 and count 1/6 of those days. Now, when you're doing the division, of course, you can tell that it's not always going to come out to an even number. So if the number is, 40.66, you use 40.66 in determining the total number of days. You don't round up or round down, you use the actual calculation. So when you add the 100% of the days in the current year, 1/3 of the days in the first preceding year, and 1/6 of the days in the second preceding year, if that result is 183 or more, you have substantial presence in the US, which could result in being classified as a resident in the US. Next slide. As with everything, there are exceptions. So there is a form, of course, there's a form for everything. It's called an 8840, and it is called the closer connection exception. So if you have an individual who meets that substantial presence test, they were physically present for 183 days or more under that 3-year formula, then they have substantial presence. Now, the exception to being considered a US tax resident, because that's what all of this is about. This is determining tax status in the US. If that individual had a tax home in that year and they had a closer connection to that same country, then they can claim non-residency status in the US. They're saying, I understand under your law, I had substantial presence. However, I have an exception to that substantial presence, and that I'm a tax resident in another country and I have a closer connection to that same country. So if that is the case, then they are obligated, should file this form 8840. And the 8840 basically lays out, here's how many days, you have to put the number of days in each of the 3 years. They ask for basic information, name, address in your home country. They want to know your passport number, your visa status in the US. Okay. Then it says, okay, of what country were you a tax resident? You would say I was a tax resident. The one we see most often is Canada, tax resident of Canada. And then it says, okay, you're stating that you had a closer connection to Canada than you did to the US. On page 2 of the 8840, those are questions that have to be answered that establish that closer connection. So they want to know, where's your home? Okay, so it's okay to say, I have a home in Canada and I have a home in the US. Obviously, if you didn't have any home in Canada, it's kind of hard to say you had your closer connection there. They'll ask, where are your banks? Where do you do banking? Where do you do business? It's okay to say both countries, because obviously if you have a lot of physical presence in the US, most likely you have a US bank account. You need that for your living expenses here. So it's okay to answer, US, but US can't be the only answer that you're putting down. One of the big questions, they ask, where do you vote? Okay, well, obviously, if you're not a US citizen, you can't vote, and you can't be filling out this closer connection if you're a US citizen. They want to know, where do you hold your driver's license? The big question is, are you covered under a national health plan? So if, say, for instance, you're saying my closer connection and tax home is with Canada, and you say, but I don't qualify for their national health, if you say no, then they want to know, well, why don't you? You have to give an explanation as to why. So if any of these countries that you're claiming your tax home and closer connection have a national health, then it is expected that you would qualify for that national health. So next slide, please. Oh, and that form 8840 is to be filed with the IRS no later than June 15th of the following year. So for 2021, you'd file it by June 15th of 2022. If the non-resident has a US income tax filing requirement, because they have certain income, they sold real estate or they rent real estate, then that 8840 is filed with the 1040-NR. If there is no filing requirement, then it's filed separately with the IRS. And a lot of people say, well, I filed this form and I never heard anything back from the IRS. And I say, well, good, because typically we don't know what happens to them, but I've never once had any client say that they got any kind of correspondence from the IRS with respect to the form 8840 that they filed. Now, the other side is there again, I have not seen this happen, but it could. If they don't file the 8840, the IRS says, and you met these rules, you didn't tell us why you weren't why you weren't resident in the US, so therefore you are. You didn't tell us about the exception. So there again, not seen it actually happen, but can't say that it couldn't happen. So we do certainly encourage all people that fall in that category to file their 8840. It's a relatively simple form. You just fill out basic information and answer the questions, send it in. So there's no downside to sending it in. So again, exception to the general rule. We talked about the individual who was physically present for 183 days or more in the current year, and they don't qualify for the closer connection exception to the substantial presence test because they were here 183 days or more. So generally, that would make you a US income tax resident. However, if this individual is resident under the domestic laws of another country, and the US has an income tax treaty that contains a provision that we refer to as the tiebreaker rule, they can claim non-residency tax status in the US under a treaty. So whereas the 8840 on the closer connection exception, your tax home and closer connection can be to any country, doesn't matter what country it is. If you're physically present 183 days or more and you want to take the exception to being a US income tax resident under a treaty, it must be with obviously a country with whom we do have a treaty. And most of these income tax treaties do have these tiebreaker rules, but some don't. So you have to really, really look at the treaty to make sure that you qualify under the treaty and that the treaty has this particular provision in it. Then that individual would be required to file a 1040-NR, a non-resident return, because within that return, they would have to give their number of days, and they would have to make the treaty election to say, I realize I was here 183 days or more in the current year. However, under this treaty, I'm still treated as a non-resident for US income tax reporting. You have to disclose the fact that you're taking that treaty position, and that's done by filing a non-resident return. But let's say that you do, you're not physically present 183 days or more, but you are physically present 183 days or more under that substantial presence test, that 3-year rule. And you do have a tax home and a closer connection to another country. There is also a question on the 8840 that says, during the current year, have you taken what they call affirmative steps to apply for permanent residency in the US? And that generally would mean you've applied for a green card. So if that individual has applied for a green card during the year, they do not qualify to take the closer connection exception. They can't file the 8840. However, if the country in which they have residency and a tax home is a treaty country that has that tiebreaker rule provision, then they can take the exception to filing as a tax resident, but not under the closer connection exception, but under the tiebreaker exception under the treaty. So it gets a little, like everything else we've talked about, it gets pretty complicated depending on the specific facts and circumstances. Next slide. Okay, so we've talked about how do you determine what the tax status is? Are you a resident or are you a non-resident? So the next question is, well, why does it matter so much? Well, it does matter, and it matters a lot. Next slide, please. All right, if you are a US income tax resident, you are required to report your worldwide income. No exceptions. Well, there is an exception. Some income could be exempted under a treaty, but we'll get into that later. But generally speaking, you have to report worldwide income. So if you're a US citizen living in the UK or living in Italy or even living in Canada, okay, because that's what we see the most, you have a requirement to report your worldwide income on a US income tax return. And you have the same, requirements as anybody else who's living in the US who's a US citizen. And what we see is, because we do have clients who are US income tax residents, virtue of US citizen living outside of the US, or somebody who's violated the substantial presence rules, or somebody who has immigrated to the US from another country. So those individuals most likely have income, assets, transactions outside of the US. And that's where things get, generally pretty complicated. As you've already heard Anna Maria talk about PFIX. That's just one of the many, many disclosures that are required if you have international transactions or assets, if you are a US income tax resident. Okay, next slide, please. All right, so what are the qualifications or the requirements for non-residents? Well, unlike US income tax residents, a non-resident reports US source income only. They are not required, or it's not proper to report worldwide income that is of a non-US source. Now, sometimes determining what's US source and not US source is a little complicated, but that's very, very specific income. But the typical types of US source income that we see on our clients who are reporting as non-residents, US trade or business. If they're a partner in a partnership, okay, that has US trade or business activity, they get a K1. That K1 activity is subject to reporting on a 1040 NR, the income tax return for non-resident. Now, as David kind of alluded, if you are a foreign person and you're a partner in a US partnership, whether it's a partnership or an LLC taxed as a partnership, and you have income from that, you should have withholding under Section 1446, under the partnership withholding rules. So, and that's done at the highest rate. So when they file their US income tax return reporting the income, typically they're going to have substantial refunds due because the withholding's at the highest rate, but the tax is at the regular graduated rates that we're all subject to. They could have income that's not connected with a US trade or business. For instance, they own US stocks of US companies, and there's a dividend that is paid. Well, that's considered US source income, but it's not connected with the taxpayer's US trade or business. Okay, so that's what it's referred to as an acronym called FDAP. Fixed and annual determinable periodic income. Okay, that type of income is subject to a flat withholding. The typical or the standard withholding rate is 30%. If that individual is tax resident of a country with whom we have an income tax treaty, many of the income tax treaties will reduce the 30% rate to a lesser rate. Generally, if there's a reduction on dividends, it would be at a rate of 15%. So if this individual has, like I said, US stock, they got a dividend during the year, they'll get a 1042-S reporting. That reporting is similar to a 1099 that a US person would get for different types of income. And that would show the amount of the dividend, and it would show if any withholding was done. If the withholding was done at the proper rate, 30%, 15%, depending on whether they submitted the fact that they were a tax resident of a treaty country, then you don't have to report it on a 1040-NR. However, let's say the rate was done at 30%, but they really qualified under a treaty and it should have been 15. If they want to get a refund of that 15% excess, then they'd have to file a 1040-NR to get that back. Okay. The sale of US real estate is deemed a US trade or business. Doesn't mean that they're in the trade or business of selling US real estate. It's just one of those subject to reporting. There again, we didn't cover this, but typically the sale of US real estate would have withholding under FIRPTA, under 1445. Again, the withholding is generally far greater than the actual tax on the profit, so they would generally get a substantial refund. And as Caroline mentioned with the estate tax filings, we've had substantial issues in individuals getting their refunds on FIRPTA withholding because the IRS isn't properly giving them credit for the payment. If there is a rental of US real estate, they have the default is 30% of the gross rent is the tax and it's sent to the IRS, or they can elect to have it treated as effectively connected with a US trade or business. They can file a 1040-NR, report the rental income, take benefit of the expenses, and pay at the graduated rate. So we do a lot of returns reporting rental activity of US real estate. Okay, so that's the general differences in the reporting, and as you can tell, they are very significant. Okay. Now, my last bullet point on there, let's say you're a non-resident. So we've always said if you're a resident, you're subject to all these foreign disclosures of activity. Typically speaking, if you're a non-resident, since you're reporting US only, you're not required to file any of those forms. However, if you are filing as a non-resident and you are filing as a non-resident because you had the availability of this treaty tiebreaker provision, the law says that you are reporting as a non-resident for purposes of reporting your income only. So that means you're only reporting US source income. However, for all other purposes under the code, you are treated as a resident. So that can be very significant. Next slide, please. All right, so we've hit on a few of these already, but it's not exhaustive, but this is the list of the different forms that are required that can report some sort of offshore activity, okay? The 8833, whenever you're claiming a treaty position, you have to attach the form 8833 to give details of the position that you're claiming. Anna Maria spoke briefly about the form 8938. Okay, that would be required. She also talked about 8621 PFIX. So now here's the thing, like with the PFIX, they wouldn't be required to report the income, okay, because they're reporting US source income, but they would have to disclose. So the filing, just the time to do the filing is significant. Form 5471, that's for closely held corporations. We had a Canadian, individual and he never exceeded the 182 days in a year. 1 year, due to certain circumstances, he was here 189 days. Of course, we didn't find out until, much later. So we couldn't advise him because it was already done by the time we got it. Well, so we said, okay, you were here 189 days. We have to ask you a whole bunch of more questions about what you have outside of the US, even though it's not going to affect your US income tax, okay, but it's disclosure. And it turns out he had 3 closely held foreign corporations in Canada. And he was shocked at the fee we charged to prepare this, but it's a required disclosure, and the penalties for not disclosing are far more than the fee to pay us to properly disclose. So just keep this in mind if you're dealing with non-residents. Other forms, if they have a foreign partnership, 8865, they have a foreign disregarded entity, there's an 8858. If they have trusts, it can be a 3520 or 3520A. And then there's the FinCEN 114, which we all know as an FBAR. They have to disclose the foreign accounts. There again, not for purposes of reporting the income, but for purposes of disclosure. Next slide, please. All right, we already talked about what if you don't do this? Substantial penalties. As David talked about, the failure to file 5472 is $25,000 penalty. The penalties are just horrible, okay? If you don't properly disclose, let's say you're a US income tax resident, you don't properly disclose, could result in substantial unreporting of your income. I give an example, foreign partnerships, that flow through would be reportable. Controlled foreign corporations, subject to transition tax and GILTI reporting, okay, which is, relatively new, effective in 2017. If you as the preparer haven't done your job, possibly, I'm not saying this will happen, but possibly there could be preparer penalties for negligence. And so there are also penalties for filing late. Let's say you discover, afterwards that this wasn't done. There are significant penalties for late filing. Next slide, please. All right, so what are the alternatives for this? What can you do if you're in this situation? Well, we talked about reasonable cause. In our experience recently, don't count on the IRS granting reasonable cause. It's just not happening. So that's our experience. There is a program called the Streamlined Filing Procedures where an individual is not in compliance, and if is deemed not willful, that they didn't comply, not due to any willfulness, then they can enter into this streamlined filing procedure program. It makes a difference in the penalties, whether you're domestic, meaning you live in the US, or offshore, if you live outside the US. Generally speaking, you have to go back 3 years for tax return filings and 6 years for FBARs. If you have closely held corporations, and transition tax would apply, even though it's more than 3 years, you have to go back to 2017. So as the years go on, those streamlined filing could involve more years than just 3. So we've used those quite a bit. There again, it's very expensive from a preparation standpoint, and the IRS has to accept that you weren't willful. So with that, just these are the things that you need to be aware of and caution when you're meeting with clients when you're not really sure about their tax status. So that is the end of my presentation. Thank you.
Thank you, everybody. We are going to conclude there with just a few moments to spare. There's been several questions that have come through the chat, so we will be sure to address those on an individual level. We also have a evaluation that we will need to have completed in order to get your CPE certificate to you. So I am putting in the chat the link to the CPE certificate evaluation and my email address. So if you need to update your email address, I've seen a couple of comments come through. So if you registered with a different email than you need your CPE certificate to go to, please send me a direct email and I will get that information updated. So there is my email, and here is the link to the evaluation. So we appreciate your time today. We hope that it was informative. If you have any questions, let us know and we will be in contact soon. Have a great day, everybody.